Okay, thank you guys for joining us. We're joined today by Peter Gleysteen from AGL, which is a direct corporate loan fund, top performing fund, 12 billion in assets now, grown from 3 years ago. Before we get into the structure and the business, tell us a little bit about your background, Peter.
Thank you, Anthony. So I've been in, everyone can hear okay? So I've been in credit for 47 years. I've only had 3 employers, AGL, which I founded, is my third. I founded another asset manager, CIFC, which is my second, and I worked for JP Morgan Chase for several decades. So I'm highly opinionated about credit. And it's a great place to be, especially when you're looking at uncertain times like we are now.
Let's go into the investment strategy. How did you evolve into it? What was your last job, and why did you decide to do this?
So talking to investors over the decades, especially in the last 10 years, I would always ask, well, what do you want? The answer was always the same: sovereign wealth fund, pension fund, insurance company. Safety of invested principal, and a steady cash-on-cash 7%. So highly diversified, very safe, cash-yielding portfolio of corporate loans. The key to safety is diversification. I said, well, 7%, by the way, today at SOFR plus or LIBOR plus 5%, well, that's 8%. That's without leverage. This is an asset class. These assets are usually invested in with leverage because done correctly, it's really safe. You know, banks used to be levered 20, 30, 40 to 1. CLOs are levered 10 to 1. If you want 7 or 8%, you can now, you don't need any leverage, but our flagship offering is levered 2 to 1.
Do you have a point of view or take a position on interest rates, or it's an interest rate neutral fund?
Well, everything we do is floating rate. The assets are floating rate, and applying debt is also floating rate. The debt, structured credit debt's great for a long-term investor because it's long-term, no mark-to-market trigger, floating rate, 5-year reinvestment period. The repayment of the leverage of the debt of the structure is only from principal cash flows, and there's not even an amortization schedule. So it's like a bank in reverse. The assets are short-dated, and the liabilities are long. So it's what regulators wish banks were, frankly.
Peter, tell us a little bit about how your background as a banker has helped you in the credit fund business.
Thank you very much. So, because I'm now an asset manager, people in asset management, almost all assets, the only way you can enter and exit them, including us as individuals, is buying and selling. You know, whether it's an equity, whether it's a bond, whatever it is. Loans, however, and people think that asset management should risk manage credit assets by buying and selling. Well, think about a bank. Banks don't sell loans. They look for the loans to be repaid, and they don't sell. Originating banks don't use the secondary market to manage risk. They're not sellers. They sell at origination and distribution to raise capital, but the loans they put on balance sheet they hold and manage to be repaid. If you combine those two investment models, investing only high conviction of payment to maturity, but also for liquid assets, managing risk by buying and selling and fine-tuning the portfolio, it's the best of both worlds. And I have to admit, this hybrid approach, I think we're the only manager that does that candidly.
We were talking before we came up on stage, and I asked you if you were bullish or bearish. You said you were very bullish on the business. Tell us why.
Well, bullish on the business, bearish on the environment, as we all heard this morning. So as I've already mentioned, these are floating rate assets, and if you use leverage, that's also floating rate. So we're talking about senior secured loans, and the loans are all to large cap, middle cap, and some small cap U.S. companies, and it's the only way you can get credit access. It's the only credit channel to the U.S. domestic economy. If you're going to buy investment grade bonds or public equities, you're talking about multinational companies, most of whom have over 50% of their revenue outside of the United States. All these companies are 100% or 90% U.S., but there's some exceptions. And you might ask, well, by the way, what are some really big companies? United, jet lag's hitting me. There's some other U.S. airlines, but
Yeah.
United, Delta, American Airlines are all borrowers. Now, they did that after COVID, after they got government assistance. So they're very big companies, so those are public. So public companies also access this market, but it's mostly private, and it's of course where all private equity sponsors get their senior secured leverage.
So I was talking about this with my son, who's 30. If you're in our investment business and you're 40, you've experienced nothing but zero interest rate policy from the Fed up until the last several months. Yet you and I have lived in inflationary-based environments and real rate environments. What is it about your life experience in dealing with those types of environments that's beneficial right now?
Well, every so-called roller coaster ride or extreme descent of any kind is always different, but there's always a recovery. So a key thing is not to overestimate or underestimate just how bad things are get or how far you can go. Right now, I would say that for obvious reasons, there's a lot of bad news, but the bad news is overpriced. I can't speak about equities and fixed income credit, meaning bonds, but in the loans, the asset class that we're in is about $2.5 trillion, so it's not small. But it's priced in, I've said this before recently, it's priced in 3 recessions in the price. If you use a conservative implied default rates and recovery rates, and on the math which I'm happy to share in detail, and it's not hard to do, current loan prices imply a default rate of all the assets more severe than the 2009 recession. So I'm not saying it's going to be like that, or I'm not saying it's not going to be worse, but that's actually pretty bad because in 2009, yes, we had expansive monetary policy, and we had contraction or limited fiscal policy, but we had a severe recession where people stopped buying. Everything stopped. I mean, it was a really bad scene. Right now, actually, people can't get a job in the U.S. Or let me put it another way, employers can't get enough, and people are spending money. And
there are 10 million jobs that are open right now that have yet to be filled.
So I mean, it's coming, but I don't think it's coming like 2009. But we don't know exactly. But if you've been through, back to your question, pick your sport. Everybody falls, right? And you get up and get better. It's not the end, but the assets are priced like it's the end.
Well, ladies and gentlemen,
let me just add one more thing, if I may.
Please.
So we're talking about a floating rate asset class that's senior secured. I didn't mention that it's short duration. A brand new loan in this market has a 7-year final maturity. The average life is 3 years. If you buy existing loans, very large liquid market, you could have a portfolio that's an average life of 18 months. So think about a floating rate asset, short duration in a rising interest rate environment that is the most senior. It's the most senior instrument in any company's capital structure.
Well, I appreciate your time, ladies and gentlemen. Peter Gleiber, AGL. Thank you.